You are standing in your driveway in Levittown, Long Island. It is Friday, October 3rd, 2008. The garage door is open. Your kids' bicycles lean against the wall where you left them this morning. The sprinkler clicks in the yard next door. The mortgage payment, $2,340, left your checking account yesterday. Same as every month for the last 6 years. You bought this house in 2005 for $410,000. You put down $41,000. Everything you and your wife saved in 9 years, every dollar. Your lender told you the house would be worth $500,000 within 3 years. That equity was your retirement cushion, your safety net, your proof that the rules work if you follow them. You pull out your phone and open Zillow. The estimate reads $287,000. Not a typo, not a glitch. $123,000 less than what you owe. You are underwater. The asset that was supposed to protect your family now traps it. Here is the brutal math. You can't sell because the sale price won't cover the loan. You can't refinance because no bank will touch a mortgage that exceeds the collateral. You can't walk away because the deficiency follows you. The roof doesn't leak. The school district hasn't changed. Nothing about the house is different. But everything the house depends on to hold its price is gone. The credit system that gave it its number, the appraisal chain that confirmed that number, the buyer pool that needed mortgages to meet that number. All three collapsed in the same 90 days. This isn't a housing crash. This is a credit collapse with your address on it. You are still making payments on an asset you cannot sell, cannot refinance, and cannot escape. The house survived. The equity didn't. When a financial crisis hits, the common assumption is that wealth gets destroyed, prices fall, savings shrink, everyone loses. But that is not what happens. Wealth does not disappear during collapse. It moves. In September 2008, American households lost $13 trillion in 18 months. But that number did not evaporate. It transferred from one category of assets to another, from assets that needed the financial system to keep functioning to assets that did not. The question that determines which side you end up on is not how much you own. It is how many institutions need to stay alive for what you own to remain worth something. Here is what most people miss. Look at what sits inside a typical middle-class portfolio. A house, financed with a mortgage, valued by an appraiser, sellable only if a buyer can get a loan. A 401k, invested in equities, held through a brokerage, dependent on market liquidity. A money market fund, the thing your advisor called safe, holding commercial paper issued by banks you have never heard of. Every one of those assets shares the same structural property. It requires a chain of institutions to keep operating. The mortgage lender, the interbank market, the rating agency, the broker-dealer, the buyer's credit line. If even one link breaks, the asset does not just fall in price. It stops functioning. You can't sell it. You can't refinance it. You can't convert it to cash. The price didn't move. The mechanism underneath it collapsed. Now let me show you how this worked. The TED spread, the gap between what banks charge each other for 3-month loans and the yield on 3-month Treasury bills, measures one thing: trust between institutions. In normal conditions, that gap runs below 50 basis points. By October 2008, it hit over 450 basis points. Not a widening, not a stress signal, a full stop. Banks would not lend to each other. The chain didn't weaken, it froze. And when that chain froze, every asset connected to it locked in place. Not gradually, not partially, completely. Your house still stood on its foundation, but the system that gave it a price went dark. Think about what that means. On September 16, 2008, the Reserve Primary Fund, one of the oldest and largest money market funds in America, announced its net asset value had fallen below $1 per share. It broke the buck. The reason? The fund held $785 million in Lehman Brothers commercial paper. Lehman filed for bankruptcy the day before. The paper became worthless overnight. Not in weeks, not in months. In 24 hours, $785 million turned to zero. But here is the kicker. Within 48 hours, investors tried to pull over $40 billion out of money market funds across the entire industry. The Treasury Department announced an emergency guarantee program on September 19th, 3 days later, to stop a full-scale run. The product, designed to be the safest cash position in American finance, cracked open because it was chained to one institution that failed. The safety was never in the asset. The safety was in the assumption that every institution touching it would stay solvent. Same chain, same assumption, same collapse. This isn't about bad investments. This is about structural exposure. The question that separates what survives from what fails is not quality, not diversification, not the rating on the label. The question is architectural. Does this asset need the system around it to keep working? If yes, you are exposed. Your house, your equities, your money market fund, your bank deposits above the insurance limit, all of them sit on the same load-bearing wall. Credit markets, interbank lending, broker-dealer liquidity, appraisal chains, buyer financing. Remove any one and the asset doesn't just decline, it locks. If the asset holds value without a single institution needing to confirm, transfer, or guarantee it, then it sits on the other side. And during every systemic crisis in modern history, capital floods toward that side. Not because those assets are better, because they are the only ones still functioning. The middle-class portfolio in 2008 was built almost entirely on the exposed side. 5 assets sat on the other. The first asset that survived the 2008 collapse was the simplest instrument in the entire financial system: short-term United States Treasury bonds. A direct obligation from the federal government, no intermediary, no credit layer, no institution standing between you and repayment. When the interbank market froze in October 2008, capital did not sit still. It ran. And it ran toward the one instrument with zero exposure to the chain that just broke. On December 9, 2008, the yield on the 3-month Treasury bill dropped below zero, negative 0.01%. Investors were paying the United States government to hold their money, not for return, not for growth, for one thing only: no institution between them and their cash. This was not a one-time event. During the 1998 crisis, when Russia defaulted on its sovereign debt and long-term capital management collapsed, the same pattern appeared. Treasury yields compressed as capital fled corporate and emerging market debt. The spread between treasuries and high-yield bonds widened by several hundred basis points in weeks. Same trigger, same destination, same mechanism. The limitation is real. Treasuries protect you only in short-duration form and only when the sovereign itself stays solvent. In a United States fiscal crisis, this asset flips to the exposed side. But in every credit crisis short of sovereign default, Treasuries absorb the panic first. The safest asset in the system wasn't the one with the best rating. It was the one with the fewest institutions attached. The second asset had no institutions attached at all: physical gold. Not a gold exchange-traded fund, not a futures contract, metal you hold in your hand, requiring no one to confirm, transfer, or guarantee what it is worth. Gold traded near $720 per ounce during the acute phase of October 2008. By September 2011, it exceeded $1,900. That repricing didn't happen because gold became more useful. It happened because the Federal Reserve's balance sheet expanded from $900 billion in August 2008 to over $2.2 trillion by December 2008. When you flood the system with new currency units, assets priced in those units adjust upward. And this wasn't the first time. In December 2001, the Argentine government imposed the Corralito, freezing bank withdrawals at $250 per week and forcibly converting dollar deposits into pesos at a rate of 1 to 1.4. The free market rate collapsed to 1 to 3.5 within months. Your dollar savings in an Argentine bank lost more than half their value between Monday and Friday. Physical gold and foreign-held dollars? Not converted, not restricted, not touched. Same mechanism, same outcome, different continent. The limitation? Gold generates no income. In a prolonged deflation without monetary expansion, it can stagnate for decades. It is not a growth asset. It is an exit from the system that holds everything else you own. Gold didn't rise because it got better. Everything around it got worse. The third asset operated on the same principle in simpler form. Cash and cash equivalents held outside the banking system, physical currency, direct treasury holdings, anything with the fewest possible steps between you and your money. During the week after Lehman collapsed, several brokerage firms imposed delays on large withdrawals. Money market redemptions froze at the reserve primary fund and were restricted at other funds. Wire transfers slowed as counterparty checks intensified across the system. The fewer steps between you and your liquidity, the faster your access held. Argentina showed the extreme version. The Corralito restricted all bank withdrawals to $250 per week. ATMs emptied within hours. Citizens with physical cash maintained full transactional ability. Citizens with bank deposits watched their access disappear behind a government decree that lasted nearly a year. The limitation: physical cash is subject to inflation and theft. It earns nothing. Holding large amounts outside the banking system is impractical for most families. But here is what every banking crisis in the last century confirms. The most accessible money was always the money with the fewest institutional steps attached. The access didn't depend on the amount, it depended on the structure. The fourth asset survived for a different structural reason: farmland. Not residential real estate, which collapsed precisely because it depended on credit conditions. Farmland survived because its value comes from what it produces, not from what a buyer can borrow to pay for it. United States farmland values held steady through 2008 and 2009. According to United States Department of Agriculture data, average farmland values rose approximately 25% between 2009 and 2012. The same years, the Case-Shiller Home Price Index kept falling. Think about what that means. One type of land collapsed. Another type of land in the same country during the same crisis went up. The difference wasn't location, it was structure. A house needs a buyer with a mortgage. A field produces food, whether credit markets function or not. Japan showed the same split over a longer timeline. Urban commercial land in Japan's 6 largest cities fell roughly 80% from peak during the 1990s. Rural agricultural land declined far less, supported by continued output regardless of the credit freeze around it. Same country, same decade, different dependency, different outcome. The limitation? Farmland is illiquid. You cannot sell a field in 48 hours. It requires expertise to operate, and its value depends partly on policy and climate. This isn't a crisis trade. It is a long-duration store of productive value that sits outside the credit system. The land didn't need a buyer with a loan. It needed rain. The fifth asset captured the wealth flowing out of the collapsing system through a different channel. Strategic commodity positions, energy, agricultural futures, hard commodities held before the crisis hit. Here is how the mechanism worked in 2 phases. During the acute liquidity squeeze, commodity prices fell sharply, because in a cash crisis, everything gets sold. But in the second phase, when the Federal Reserve expanded its balance sheet from $900 billion to over $2.2 trillion in 4 months, commodities repriced upward. Multiply the currency units in the system, and real assets priced in those units adjust. Commodity indices recovered and exceeded pre-crisis levels within 2 to 3 years. This pattern has operated before. After Nixon suspended dollar-gold convertibility on August 15, 1971, the monetary expansion that followed repriced the entire commodity complex. Oil rose from approximately $3 per barrel to over $35 per barrel by 1980. Not a small move, not a correction, a structural repricing driven by currency dilution. Different decade, different president, same mechanism. The limitation, timing. During the acute phase, commodities fell alongside everything else. If you needed liquidity during the crash itself, commodities didn't provide it. The repricing came in the second phase, the monetary response. If you were forced to sell during phase 1, you absorbed the loss. Commodities didn't predict the crisis. They priced the response. 5 assets, 5 categories. Treasury bonds, physical gold, non-bank cash, farmland, commodities. They share no industry. They carry no common label. Not one of them appeared in the standard portfolio allocation your advisor recommended in 2006, but they share one structural property. None of them needed the credit system to keep functioning. None of them depended on a mortgage lender, an interbank market, a broker-dealer, or a rating agency to tell them what they were worth. When the chain broke, these 5 weren't connected to it. The middle class held almost none of them. The middle class held the mirror image: houses financed with mortgages, retirement funds in equities, cash in money market accounts, deposits they assumed were the same thing as money. Every one of those assets sat on the side of the chain that stopped. That wasn't an accident. That was the structure. And what collapsed reveals the architecture more clearly than what stood. Every asset that survived shared one property. It didn't need the system around it to keep working. Now flip the picture. The assets that failed shared the exact opposite property. Every one of them required a chain of institutions to function, and every one of them sat at the center of what the middle class was told to own. Start with the asset class that defined the crisis: subprime mortgage-backed securities. These instruments didn't have one institution on the other side. They had dozens. Borrowers, mortgage servicers, rating agencies, secondary market buyers, and the interbank liquidity connecting all of them. When the chain broke, it didn't weaken, it disintegrated. The ABX index tracking AAA-rated subprime bonds fell from par 100 to below 30 between mid-2007 and early 2009. Not a decline, not a correction. A collapse to less than a third of face value, while the rating still said safe. Rating agencies downgraded thousands of tranches. Secondary market liquidity didn't thin out, it vanished. Could you have survived holding them? Yes, if you held them unleveraged with no need to sell. But the middle class didn't hold them directly. The middle class held them through funds, pensions, and structured products that needed liquidity to stay alive. The rating survived. The value didn't. Next, leveraged equities. When the credit chain froze, margin calls triggered forced selling, regardless of what the underlying stocks were worth. The S&P 500 dropped approximately 40% between September and November 2008. Not over a year, not over 6 months, in 8 weeks. Hedge fund liquidations accelerated through the fourth quarter. Falling prices triggered margin calls, which forced more selling, which pushed prices lower. A self-feeding loop with your retirement account inside it. Think about what that means. Your 401k didn't decline because the companies in it became worthless. It declined because the leverage mechanism around the broader market collapsed. If you held equities with no margin and no need to liquidate, the loss was temporary. But most middle-class retirement accounts were locked inside target date funds that couldn't be restructured without penalties. The structure trapped you. Then, residential real estate, the largest single asset the average American household owned. The Case-Shiller 20-City Index dropped approximately 35% from peak to trough. But the problem wasn't just the price. Homes couldn't be sold because buyers couldn't get financing. They couldn't be refinanced because the loan exceeded the collateral. The asset didn't just lose value, it lost the ability to function as an asset. If you owned it outright, no mortgage, the decline was painful but survivable. If you were leveraged, the house became a cage. And finally, bank deposits above the Federal Deposit Insurance Corporation insurance limit. In theory, deposits are money. In practice, deposits above the insured threshold are unsecured claims on the bank. Cyprus proved this on March 25, 2013. Deposits above 100,000 euros at Bank of Cyprus were hit with a bail-in. Depositors lost nearly half of everything above the insurance line, converted into bank equity between breakfast and lunch. Same structural flaw, same outcome, same people exposed. Every asset on this list failed for one reason. It needed the credit system, the banking system, or the chain around it to keep running. When that chain stopped, these assets didn't just lose price, they lost function. The middle class held all of them, and almost nothing else. The mechanism that transferred $13 trillion in 2008 did not retire when the crisis ended. The structural conditions that made it possible are still in place. In several dimensions, they have gotten worse. Here is what most people miss. Look at where the middle class keeps its wealth today. According to the Federal Reserve's Survey of Consumer Finances, American household net worth remains overwhelmingly concentrated in two categories: primary residence equity and retirement accounts invested in equities. The same two asset types that failed the dependency test in 2008. Same allocation, same exposure, same architecture. The people who rebuilt after the crisis rebuilt into the same structure that collapsed under them. The crisis changed the numbers, it didn't change the blueprint. Now look at the backstop. In 2008, the federal government stepped in with emergency lending facilities, treasury guarantees, and the Troubled Asset Relief Program to keep the chain from snapping completely. That intervention required fiscal room. United States federal debt has surpassed $34 trillion. Global government debt exceeded $90 trillion by 2023, according to the Institute of International Finance. Debt to gross domestic product ratios across major economies have reached levels historically associated with reduced fiscal flexibility. The next time the chain breaks, the institution that caught it last time will have less capacity to catch it again. Think about what that means. And the chain itself? It didn't get simpler. The notional value of outstanding over-the-counter derivatives remains in the hundreds of trillions, according to Bank for International Settlements reporting. Post-2008 reforms pushed exposure into central clearinghouses, which reduced bilateral risk but concentrated it into fewer, larger pressure points. Not shorter chains, not simpler chains. The same chains rerouted through bigger single points of failure. This isn't a forecast. This is a structural diagnosis. The same conditions, the same asset concentration in the middle-class portfolio. A thinner fiscal backstop. A longer, more concentrated chain. The pattern documented across 2008, Japan in the 1990s, Argentina in 2001, and Cyprus in 2013 did not emerge from unique circumstances. It emerged from an architecture that has not been redesigned. Here is the brutal truth. The conditions that produce the transfer are not exceptional. They are not rare. They are the default design of the modern financial system. And the middle class, the people who followed the advice, bought the house, funded the 401k, remains built into the exposed side. The question was never if the pattern repeats, only when. You are still in Levittown. It is 2012. The garage door is open. The bicycles are gone. Your kids outgrew them. The lawn is the same lawn. The mortgage payment is still $2,340. The house is worth $295,000 now. Better than the bottom. Still $115,000 less than what you owe. You have made 48 more payments since the night you checked Zillow and saw the number that changed everything. That is $112,320 sent into an asset still underwater. You couldn't sell in 2008. You couldn't refinance in 2009. You can't walk away in 2012. You did everything right. Good school district, 10% down, every payment on time. The roof never leaked. The foundation never cracked. Nothing about the house changed. But the house was never just a house. It was a claim on a credit system. And when that system broke, the claim broke with it. The payments continued. The equity didn't. Every asset the middle class held needed the same system to keep running. The system stopped. The assets didn't survive. The debt remained. The safest portfolio in America was the most dangerous, because every asset in it needed the same thing to stay alive.